All right, let's jump in. Hi, everybody. I'm Crissi. I'm the founder of Penny Finance. This is the Student Loan Survival Guide Masterclass. If you haven't been to one of our masterclasses before, we do these almost every month on a hot topic in financial wellness to make sure you're armed with all of the answers and resources for your financial world. We have a ton of people that signed up for this session, so I'm sure there will be folks trickling in. So for those of you that just joined, this will be recorded. It'll be sent out to you. It's an interactive masterclass on all things student loans. The reason we're here, women hold 2/3 of the country's 1.54 trillion student loan debt. This is because women have been getting more degrees since the 1980s. So a lot of people like to say we're smarter, but we are also not as rich because we have student loans. So that makes it an extra burden for us. Credit card debt grew 14% during the pandemic for student loan holders. So double whammy. On top of that, what we see in our community of women, there's 20,000 women that use Penny for their personal finances. 25% are never going to pay off their debt. And we don't want this to happen. This is fixable. And so that's the main reason why we are here today. I am so excited to introduce our guest. Many of you know me. I'm the founder and CEO of Penny Finance, based here in Boston, but I'm so excited to introduce Lindsay. Lindsay's the chief borrower advocate at Savi. She spent a decade in advocacy and fintech, focused on helping people pay down their debt. We both personally have accumulated a ton of student debt in our lives. I went to Bentley and NYU. She went to Yale and Columbia. Thank you, Northeast schools, for giving us all the debt in the world. She's a contributor to The Nation. I'm a contributor on Forbes, AKA we care very much about this topic. We've spent a long time in finance and focusing on advocacy and debt. Penny makes financial advice easy. Savi makes student loan repayment easy. And together, we've built this masterclass for you to help navigate this crazy student loan world. Before we dive into the agenda, I just want Lindsay to be able to say hi and add anything else about herself and her company.
Yeah, thank you so much, Crissi. And it's so great to be with you all here today. I mean, Penny is just such an incredible company. So we're really excited to get to work together. As Crissi mentioned, I'm a student loan borrower myself. Just to give you a sense, I have a little over $200,000 in student loan debt. So if that makes any of you feel better about your own situations, then mission accomplished right off the bat. But really excited to be able to sort of walk you through today some of the most important things that you should know about your student loan debt. I would consider myself an expert now, but, as a borrower, when I first started paying out my loans, I was not. And so I know that these programs are overwhelming and complicated, and that's exactly why we're here to sort of cut through all that. So excited to dive in. And again, thank you so much, Crissi, for having me.
Of course. Okay, so here's the agenda. And with all things Penny, drop your questions in the chat throughout. We love to go through real life situations, but our goal today is to first figure out, could you potentially still get your loans forgiven or pay $0? That would be awesome. What if your loans are in default? What do you do? We're going to figure out a payment plan. We have all these interactive tools for you to use to figure that out. That's going to make you feel so much better. Just like, for example, if you have $30,000 in loans, your payment could be less than $200 a month. Let's forget the total number. Let's just focus on, what do I need to pay every single month? Consolidation and refinancing come up all the time. These are big words. Nobody understands them. We're going to go over if they could potentially be right for you as a strategy with your loans. And anything else in between this, we're happy to answer. Okay, the big news, October 1st, student loan payment pause ends. It's not exactly October 1st. Your payment could be October 12th. Your payment could be October 21st. It could be October 31st. But the government for 3 years has paused student loan payments. They are back for good. It's official. So that is the big reason why we are here. We just want to share some dates before we dive into the nitty gritty. On September 1st, interest resumed, meaning your loans got turned back on. That doesn't mean you owe anything yet. It just means they got turned back on. October, you're going to get a bill to make a payment. Lindsay had just told me while we were prepping for this that a lot of the bills haven't gone out yet. So that is a major problem. A lot of people don't even know what they need to be paying on their loans. So we're going to handle that. And then there's a new program called Save, which we're going to dig into, that's available now. It could really help you with your payments. These are examples of companies that fall into this camp. Federal government loans, Advantage, Nelnet. These loans, Sally Mae, Discover, SoFi, who you have the loan with, nothing has changed with those. You should have been paying them. They were not paused. These are private loans with private banks. They're not with the government. I'm going to pause there for a second. Lindsay, add anything I missed or any nuances. And for anyone who's looking at this screen and they see their company on it, feel free to add, put in the chat any questions around these topics, because private loans were never paused, just government loans.
Yeah, one thing I was just going to add, actually, if we can switch back to the previous screen, if that's possible, just so those companies below, Advantage, Mohila, Nelnet. So, as Crissi said, these are examples of federal servicers. These are companies that are contracted by the Department of Education in the repayment and management of your student loan. So that's the account that you'll log into to see your bill date, you'll make that payment, et cetera. One thing I just wanted to flag for all of you guys is that over the last couple of years, while payments have been paused, a couple of the major servicers actually ended their federal contracts. And so what that meant was that borrowers who had loans serviced by those companies were moved or transferred to new or different servicers. So there's a good chance that the servicer you might have had before the payment pause is going to be different than the one that you are going to have going into repayment in October. And a lot of borrowers actually were unaware that they got moved. So it's a great idea to check and make sure you know what servicer you have. And you can do that by going to the website right at the bottom right here, studentaid.gov. Log in using your federal student aid ID. This is what you basically created when you took out the loan to begin with. And right as soon as you log in, it'll show you on that screen your servicer. So you'll just want to make sure you know who that is and that your contact information is updated so that you can actually receive those bills. Because we've seen many borrowers who their servicers have changed and they're not getting that information because they haven't set up their new servicer account. So just wanted to flag that for you all.
So Lindsay, like an example of that, the servicer might be Advantage, but the loan is called
It's called like a direct federal loan. So the Department of Education sort of owns the debt, but it's serviced by this company. And that's that's the account you can log into, your Advantage account, et cetera. But if regardless, for any federal loan you've ever taken out, studentaid.gov is the official Department of Education website that will have a record of that and will show you what your servicer is.
Okay. So don't worry about figuring out who, just go to studentaid.gov. You'll see all your federal loans there.
Yeah, exactly. And you'll see what servicer you have and you can link from there.
Okay. Fabulous. All right. Is relief still an option? This is the first question. So as you all may be aware, the Biden administration tried to push through a mandate that basically forgave 10 to 20,000 in student debt. That did not get approved by the Supreme Court. However, there are some employment types that still allow you to get your loans forgiven. So what we did is we built a page on the Penny platform where you can put in your type of employer, your marital status, and your income to see what your options are. You might be eligible for reduced payment. You might be eligible for forgiveness. We wanted to just cut, like Lindsay said, it's so complicated. You're not going to read all these pages on the government website. Put your information in. I'm going to put an example in of one of our Penny members that just emailed us. This is pennyfinance.com/student loans. She said she works for a nonprofit. So the three institutions that are eligible for public loan forgiveness are government, nonprofit, and potentially teaching institutions. So I'm going to say nonprofit. Marital status, this is important for different plans that the administration offers for reduced payment in determining your eligibility for income. She's single and she told me her income is 50,000. I'll put in my email for now. See my options. So for someone like this, and you could put in your personal information now, she's not eligible for a reduced payment plan. It's called the SAVE plan, but she is potentially eligible for loan forgiveness because she works in nonprofit. And we've linked the pages that you would go to. This is the public loan forgiveness platform, so you can get information on that. Use this, it's free, send it to all your friends. We want to make sure everyone has the information on can they get them forgiven and can I have a reduced payment. Lindsay, anything you would add here? We're going to dig into the SAVE plan and what it means and all of the nuances. And if you're in default, but anything you would add here on basically public loan forgiveness, particularly.
Yeah, I was just going to say, with this program, Public Service Loan Forgiveness, this has been around since 2007. And unlike sort of Biden's forgiveness program, this is not going anywhere. And in fact, it's only getting better. They've made a lot of improvements and expanded eligibility for this program over the last couple of years alone. So I would say if you are curious, and it could be your current employer, it could be previous employers. The program is completely retroactive back to 2007. And it doesn't need to be continuous. If you worked for a qualifying employer for a couple of years, you could get a couple of years worth of credit, and you just need 10 years total cumulatively in order to qualify to have the remainder of your loan balance forgiven. So definitely worth checking out this page and seeing if, your employment qualifies and then pursuing that program.
If you're in default, the government is giving you a fresh start. We put the link to the site here. Basically, default means you hadn't paid your loans previously before the pause happened and your loans went into default. They are basically waiving everything and letting you start over effectively. That's the easy way to explain it. myeddebt.ed.gov. Lindsay, you're the expert here. Any nuances or anything people need to consider with this fresh start program?
Yeah, this is, again, if you're in default, this is a way to really sort of get out of default quickly. It takes about a month for this process to go through. Normally, outside of this fresh start program, getting out of default requires a rehabilitation process, which takes upwards of 9 months. This is different. So you can go to myeddebt.ed.gov, or you can actually call the collection agency, which has your loans, and verbally initiate this program for yourself. And like I said, once you do that, it'll take about a month to process, and then your loans are brought completely back into good standing, which means you're now eligible for any type of income-driven repayment plan, to take out more student loans or get more financial aid. You're able to qualify for forgiveness programs like public service loan forgiveness. So this is something that is actually, it's ultimately going to expire about a year from now. So for anyone in default, I highly recommend you take advantage of this Fresh Start program.
Okay, next. So first we want you to, just to recap, we want you to check, can you get your loans forgiven or can you still pay $0? If you're in default, reset them. Let's get them back into good standing, restart. Now your payoff plan. So this is the meat of our session. There's a bunch of different options. I'm going to hand it over to Lindsay now so she can IDR you're going to hear a lot about this. And I've been in the finance industry for almost 20 years. Never heard anyone talk about IDR until now. These are basically not new. They are payment plans for your student loan. So Lindsay, can you help give us a deep dive into what are the 4 different types and how to think about this and all these acronyms and what all of this means?
Yeah, absolutely. So first I'll back up a little bit and just give a kind of higher perspective on repayment plans generally. So you can kind of think about it like this. There are 2 main ways to repay your student loans. There's sort of what's called the standard plan, and then there are what are called income-driven repayment plans. So these standard plans, this is what you are automatically put on when you graduate. And that basically estimates your monthly payment on your debt amount and the fact that you're going to pay that off in 10 years. So if you're someone like me who has over $200,000 in student loan debt and they estimate you're going to pay that off in 10 years, that monthly payment is going to be upwards of $1,000, $2,000 a month, right? And so what the Department of Education realized was that most borrowers could not afford to make the monthly payment on a standard plan, again, based solely on the debt amount that they owed. So they introduced what are called income-driven repayment plans. And what these plans do, and there are 4 different types, is that instead of basing your monthly payment on your debt amount, they base it on your income. And they also factor in things like your tax filing status and your family size. So regardless of how much you owe in student loan debt, it could be $5,000, it could be $500,000, right? It doesn't matter. Your monthly payment is going to be based on your income. And so, like I said, there are sort of 4 primary types of income-driven repayment plans. So IDR is sort of the umbrella term, and then you have these different types. So there is the SAVE plan, Saving on a Valuable Education Plan. This is the newest plan that was just introduced by the Biden administration and is going to replace the REPAY plan. There is Pay As You Earn, PAYE. There is income-based repayment, or IBR, and then there's income contingent repayment, or ICR. Now, depending upon a few different variables, like your disbursement date, your loan type, et cetera, you can qualify for either one or a variety of these. Like, for example, if you had a Parent Plus loan, which is a loan taken out by a parent on behalf of a child, you would need to consolidate that loan. But even once consolidated, it's only eligible for one type of income-driven repayment plan. So again, the type of federal loan that you have, and there are a couple different types, is really what's going to determine your eligibility here. But all to say that the process kind of works like this. There is an application that you need to fill out, and you need to attach documentation attesting to your income. This can either come in the form of your most recent tax return or a pay stub from the last 90 days. Now, if you are someone whose income fluctuates, let's say you are hourly and in some months you earn more than others, you're going to want to use a pay stub, because basically what they do is they take that pay stub from that month and they extrapolate it over the year as your income. So if you are able to apply for this program and use a pay stub where, let's say your income was lowest that month, they're going to use that, and that's going to be the basis of your income. The reason why you want to have a lower represented income is because that's going to give you a lower monthly payment. All right. So a lot of borrowers don't know that. Now, if you're unemployed, you don't have to attach any supporting documentation at all. They basically take your word for it. So you submit this application to your servicer, that Aidvantage, Mohila, et cetera. They review it and they say, okay, Lindsay, you're going to pay $150 a month. And it locks in that payment amount for 12 months. 12 months comes and goes, and you have what's called a recertification deadline. And basically by that deadline, you need to resubmit the IDR application with updated income documentation, and then they sort of recalculate it again. So on these plans, your income is going to determine your payment amount. And obviously, if your income varies from year to year, right, your payment amount could vary from year to year, but it will at least lock it in for those 12 months. Now, for every child dependent that you have, that can actually lower your monthly payment by about $50 per child. Even unborn child dependents count. So that's something that can factor in to help reduce that monthly payment. So especially for borrowers, I'll sort of wrap this up here, I know that was a lot, that have a high debt to income ratio, IDR plans can be a powerful way to really reduce that monthly payment. And then here's sort of the good news. After 20 to 25 years on that plan, and on this SAVE plan, it's going to be even shorter than that, you are actually eligible to have those loans forgiven. It has nothing to do with your employer or anything like that, but you can actually have that debt forgiven. So again, these are ways to really help kind of lower that monthly payment so that you aren't falling into default. So happy to answer any questions. I know that was a lot, but
okay, 2 follow-up questions, and then I think we have a couple questions from ladies. 20, 25 years.
Yeah.
So long. What if somebody doesn't want to wait that long?
Yes. So you can always make bigger payments and pay down that loan how you want to. This at least is a way to secure a lower monthly payment. And then you can make additional payments on top of that, right? Sometimes on that standard plan, it could come out to $700 a month and you are struggling just to make that, right? So this could at least get you on a lower payment plan, and then you could make ad hoc additional payments to help pay down that debt faster.
Okay, second question, and this is from a Penny member. If how are they able to do this? Because you still have the same interest rate. So if you're paying a lower payment, are you just accumulating more debt because you're not paying enough of the interest on the loan?
Yes, essentially you are. Like income-driven repayment plans are not going to be a way to pay off your loans faster. They are going to be a way to pay less each month. So just to sort of be clear about that. I would say I'm a perfect example of this. The fact that for many borrowers, their monthly payment is barely even covering the interest. And under normal circumstances, that interest gets capitalized and tacked onto your principal balance. So I can surely relate to this. Many borrowers have been paying for years, if not decades, and their balance has not only gone nowhere, it's actually increased, right? Because of that interest. However, on this new save plan, one of the things that they have introduced is that regardless of how little you are paying each month, and it could be $0 a month if you qualify based on your income, any extra interest that is unpaid, they are going to subsidize in perpetuity. So it will not get tacked onto your principal balance. So what this is that your balance is assured to not grow, which is a great thing.
Amen. Thank you,
Yes, amen.
United
Yes.
States of America, for doing something right.
Exactly. So that's why this save plan is something to really look at, especially for that interest component. So yeah, hopefully that.
Gracie has a really great follow-up question.
Yeah.
Is save and these repayment plans, are they going to last past the Biden administration, or is this dependent on what happens in the 2024 election?
Yeah, so these are going to last. These are actually written into sort of the federal regulations, so they aren't able to be overturned by administration. They could introduce a new plan or a different plan, but once they go through the federal process and the regulations process, they are sort of written into law. And so for any borrower that had their loans basically dispersed when this plan was available, it is required to be available. You're basically grandfathered in, so you will always have that opportunity available to you. The only thing that could change is it gets better. Like they include more things in it.
Okay, fabulous. Mandy, any other questions before we keep moving on?
Yeah, in terms of income for this, Lindsay, what if you own your own business and don't have pay stubs?
So if you own your own business and don't have pay stubs, let's see, you could use if your income is fluctuating and you want to use sort of a snapshot of that, you could your servicer might be able to tell you an alternate form of income documentation that you might be able to submit. It could come in the form of a letter. So I would check out your servicer website. They usually have an FAQ where it says documentation accepted. And then if you have any issues, you can feel free to reach out to us. This is where we can kind of act as an advocate. But that's one where it might be a little sort of unique. But sometimes like a letter, a form letter, basically stating here's my income works. They kind of take your word for it. It's incredible.
Great question.
Wonderful. Keep on this topic. Before we move to the next topic, we got a question interim in regards to the Fresh Start program. So you guys tell me when you're ready.
Yeah, let's answer that quickly. Yeah.
Okay. So this person's in an income-driven program, and the question is, once school and enrollment is over, do these Fresh Start programs exist for those that are unemployed? Loan forgiveness or loan debt forgiveness, as an example, are these options available for people that are unemployed?
Yeah, so as far as public service loan forgiveness goes, right, that is one purely based on your employment. So that's going to matter whether you are employed or not. But as far as programs like Fresh Start, that has nothing to do with your employment. That only has to do with the status of your student loans, whether they are in good standing or whether they're in default. So that doesn't matter that you are unemployed at all. So if your loans are in default, then Fresh Start is something you're going to want to take advantage of. But unemployment sort of is irrespective of that. Hopefully that makes sense.
Yeah, and just to follow on that question, because I could see this coming up if someone's not in default, but they're not going to be able to pay their loans next month. Like, I think that's a lot of us, even if you are employed. What do you do? Do you just let it go into default?
One of the things that the Department of Ed actually, in announcing the return to repayment, they also announced sort of this 12-month on-ramp period starting in October of this year, going through October of next year. That basically assures that If you aren't able to make your payment for any one of those months or all of those months, you will not experience the negative consequences of missing a payment, making a late payment or partial payment. So that primarily includes going into default and getting reported to the credit bureaus. They will not be doing that for the next 12 months. So that's sort of a little bit of a safety net that they're trying to protect borrowers, in this return to repayment.
Okay. Mandy, we need to add that to our student loan survival guide because I think that's huge. A lot of people are freaking out, and it's great to know that there's a 12-month grace period. Effectively, you should still be paying your loans, but it's not going to impact your credit, and your loans aren't going to go into default, which is huge.
Exactly.
Okay, let's talk about Save because this is the new plan that has the most benefits, effectively at reducing your payment. And I love this example that your team put together of somebody, she's a nurse, she makes $77,000 a year. Right now, she was on an income repayment plan for her loans. She was paying $295 a month, but she applied to this new Save program now that it's available and reduced her payment to $61. Can you walk us through? My two questions for you on this is, I thought Save was only available if you made less than $30,000.
So no, the Save plan is available. There's no income gap on the Save plan. Right now, the only type of borrowers that Save is not available to are borrowers that have Parent Plus loans. They're not eligible for Save, but otherwise, whether it's undergrad or graduate loans that you have, there's no income, sort of gap on this. What you might be thinking of, Crissi, is the fact that any borrower making about $32,000, $35,000 or less a year is eligible for a $0 monthly
$0 payment. Got it.
So that's So I can walk you through a couple of things that this, sort of the changes under Save. So one of the way, as you can see here, right, the old monthly payment was $295. Now on this new plan, it's $61. So this new Save plan, significantly reduces or decreases monthly payments by increasing the income exemption that exists on these income-driven plans from 150% to 225% of the poverty level. So not to get too technical here, but basically what that means is that they are going to be considering less of your income when it comes to calculating these monthly payments. The other thing, like we talked about on the previous slide, was that, it eliminates 100% of remaining interest after you've made a schedule payment each month. So basically, let's say you have $50 in interest that accumulates each month, and you have a $30 payment. The remaining $20 would not be charged, if that makes sense. Okay. So that's amazing, right? And then some of the things, so that's starting right now. That's gone into effect right now. Now, starting in the spring of 2024, this plan is going to get even better. For any borrower that had an initial principal balance of under $12,000, okay, you're actually going to be eligible for forgiveness on this plan on your loans after 10 years. And for every $1,000 that balance goes up, so let's say you had $13,000, you're going to be eligible after 11 years. So that 20 to 25 years is starting to come down, right? And you're going to be eligible for forgiveness on this a lot sooner. So that's one of the exciting things that we're looking forward to. But this is supposed to be the most affordable of all the income-driven repayment plans and should help significantly reduce that payment.
Is there any reason someone would not be eligible for this Save plan?
Yeah. So, I mean, again, based on their loan type, right? So a Parent Plus loan borrower, that loan is not going to be eligible for this Save plan. I would say depending upon, your income, a couple of the other plans actually have better options for higher income borrowers, those with incomes over $150,000 a year. And so it's worth, studentaid.gov has a calculator where you can see your best options. So that's going to sort of impact, I would say, what you want to think about when enrolling in these plans.
Okay. Now, you said studentaid.gov. We want to tell people what to do. Okay, we know a little bit about Save. We know there's other income repayment plans. We know there's fresh start. There's all these different options. What do people need to do next? You need first a couple pieces of information, right? You need to know your loan balance, your interest rate, your current monthly payment. You can find this out by going to studentaid.gov, whether you know who the servicer is not. I will probably add to this list who is your servicer, so you can go to their site and see what they need to apply for these programs. Where do you apply for SAVE? Once you know this information, you know who your servicer is, you're ready to apply for the program to see if it works for you.
Yeah, you can actually apply through studentaid.gov. And there's an application process basically right on the site there, where you can submit that application. You can also do through Savi, which I know we'll talk about in a little bit as well.
Yeah.
But that might be the best way, for you to do this pretty quickly. It takes about less than 10 minutes, I would say.
Fabulous. Let's go into Savi, because where my mind is at right now is I think about our women and I think about their loans. And a lot of people have 3 different types of loans. They have a parent plus, they have a unsubsidized loan, they have a direct loan. They're married, so they have joint income at play here. Let's go into your platform so we can see basically what you've built, which helps people is you take their information and show them what the different options would look like. This would be your payment. So let's go in there. Let's do a couple of examples for people, because it's helpful just to see it visually sometimes. So let's say someone's married and they're, like you said, over 150,000. Let's say they make 175,000 jointly. And their federal monthly, so this is why you need your loan payment information, right? This is whatever you do. This is basically, this number you need is on studentloan.gov, and it's whatever is due next month, correct?
Correct. Yeah. Or if you can remember, it can be an estimate. If you remember off the top of your head, what you were paying before the payment pause went into effect.
So let's say,
I would say with that income, probably like, $400 or $500.
Yeah, $429. Get my estimate. This helps us visualize what the options are. Okay.
Okay. That's
now
gonna be fun. So until we add more information, information, keep it going.
Live in Connecticut, married, filing jointly, married, dependents, 1 kid, 1 child, and your date of birth, 5/23/1989. Next. Okay, it dropped a little bit.
Yep.
How much do you currently pay? Has your income decreased?
And one of the reasons why we asked that question is, to determine whether or not we're going to want you to attach your pay stub or a tax return. Because if it has decreased, we're going to want to use a pay stub as a more accurate reflection of your current income.
Got it. Okay. So this helps you navigate, like making sure you're putting the best application forward to reduce your payment the most.
Yep, exactly.
Do you have taxable income? Yes. Has your income decreased? No. Yes. Okay, enter your joint. So this was the number I put in.
Yeah.
AGI. So let's explain this to folks.
Sorry, go ahead, Crissi.
This is from your tax return. Your AGI, your adjusted gross income, is what you're paying taxes on every year. So you can find this on your tax return.
Now, what I was going to say, Crissi, actually, is that this new SAVE plan it actually excludes spousal. So normally when you're married filing jointly, right, it includes the spouse's income, right? So it makes it higher. Under this new SAVE plan, it excludes that. So if you want to put, like, let's say just the single income of the borrower, right? Like, let's say it's 175, but maybe on your own it's 75 or something like that. You can actually put it right in that AGI thing as well.
I could put it in here.
That'll update. Yeah.
Okay. Mine is 50,000.
Okay.
Next. So
so this is why this is going to be the most affordable IDR plan to date. So it's just going to look at your income and it's going to drop significantly.
Got it. Okay.
So now this is the employment section. So this is where, if you worked for, a qualifying employer, we have a database of all of the public service loan forgiveness eligible employers in the country. So you can start typing in the name. Maybe it'll pop up from a drop-down menu. any nonprofit, and you can add it there. You can add current or previous employment, and then you can continue right along.
Okay.
And then at this point, this is where we're going to ask you to register, because so we can save this information. That way you don't have to re-enter the stuff you already entered before. And we're also about to go into the loan sync portion, where we're just going to ask you for those loan details. So we want to be able to save that securely for you.
Got it. I'm going to pause here because this is an example and I don't thankfully have paid off my loan, so I won't be able to get in. But what I wanted people to see is like how you can use this tool to see what your payment could potentially be before even applying for the SAVE plan and understanding how the program works. I did not know that SAVE looked at your individual income. I was under the impression that it looks at your joint income.
And so this is one of the ways in which they're trying to help, because many people often balked at that, right? Because it was like, well, my spouse doesn't have loans. It doesn't matter what that income is. And so that's going to look at your individual income. So it can really help lower that savings.
Okay. And then if I were to continue on that platform and it shows the different options that you have, Savi also files the application for you based on all that information uploaded, right?
Yes, absolutely. So basically what after you registered, what you do is you can either sync your loans, using our Plaid system, which if you have Venmo, you've used Plaid before, it syncs right to your servicer account. So that way we can actually see the balance, the interest, et cetera. And then, we show you your options, what income driven repayment plans you're available for, to enroll in, how much you'd pay over time, how much each month, any potential forgiveness. And then basically with the click of a button, we start pre-filling and digitizing those forms for you and then submitting them on your behalf. And then you have a dashboard when you log back into your Savi account at any time where you can see the status of that application. Let's say you had any change in income, right? You can actually submit an income driven repayment application as many times as you want throughout the year if your income has changed, and lock in your payment at a lower amount. So you can do that through Savi at any point in time. And then we offer one-on-one support. So you can message your dedicated agent through your Savi account, or actually call and speak with someone, which I know is, for me, I like talking to someone about my student loans rather than, sometimes doing things online. So we offer all that support.
Amazing. Pausing here. Mandy, any questions from the audience before we
there
move
was
on?
a question. I was just going to get back to her myself because you sort of just answered it, Lindsay, but I'm going to ask to make sure we're in total clear. This person was automatically enrolled in the SAVE plan, is not due to make payments until September 2024.
Okay.
But knows when payments resume, they're significantly higher than she can afford. She's had an increase in income. Should she reapply for the SAVE program or another repayment plan?
I would look at your options on the other income driven repayment plans. What we're seeing is that SAVE might not be the best option for everyone. So, if let's say you go through the Savi tool and you enter in that information, it's going to show you, what that lowest monthly payment, could be if you want to pay it off faster, right? What the, least amount of payment time could be. So that will help you look into your options, but I would definitely reevaluate, given the new program and how some of these have changed and your change in income.
Thank you. Okay. I want to just talk for a second about payments. So just because, you hear all the time, oh my God, I've been making payments, but my balance is growing. So just to be clear, before we dive into this and I explain how the payments work and how to figure out your payment, if you're on the SAVE plan, even if you're not paying the quote unquote minimum payment, that's okay because they're not adding it to your loan balance, correct? Oh, you're on mute, Lindsay.
Sorry, whoops, I forgot about that. So it's interest. So it's how much interest you're accumulating. So, the example I used again, $50 in interest accumulates each month. If you only made a $30 payment, right? Like your payment, regardless, is always going to pay the interest first and then the principal, right? So what they're saying is if you made a $30 payment and you owed $50 in interest, maybe your total payment was $150, right? Or your bill amount due, you had, and 50 of that was interest. You only paid 30. The remaining 20 would not be tacked onto your principal balance. Normally it is. So you're still going to have an interest rate. That's interest is still going to accumulate. It's just, if you don't quite cover it all each month, it's not going to accumulate.
Be added. So effectively, they'll just have the same loan balance in 10 years.
Exactly.
Okay. Now, if you are not on the SAVE plan and you have other federal loans, is it possible that you're not paying enough?
I mean, potentially, yeah. And this is, this is why I think looking at, your debt to income ratio, right? Like if you have under $10,000 in student loan debt, you might be better off on one of the standard plans that's basing it on your debt amount, right? Because you can pay that loan off pretty soon, and your payment might actually be higher on an income driven repayment plan than it is on a standard plan, right? Because you don't have enough debt. So, I mean, I know 10,000 sounds like a lot, but compared to some of us.
But
so, yeah, so you might not be, right? And so that's why it's worth looking at both your standard and the income driven repayment options.
Right. So for people with standard loans or private loans, or this applies to any other loan, like the basics of loans. And I'm just going to go a little bit into personal finance for a second, because I want everyone to have this in their mind always. If you have two loans, this is an example, this is almost 70,000 in loans at two different interest rates, 7.8% and 6.2. To just cover this interest, which goes into the bank's pocket, this doesn't pay down your loan, you need to be paying at least $443 per month. So if you're paying less, you're never going to pay off these loans, right? Like they're just going to be there forever. We want to make sure you right size your payment so you're chipping away at your loan balance so these loans are gone. This is not like, don't think about this if you're going to do the SAVE plan, because that's going to help you to pay off those loans. And they're, like Lindsay said, starting next year will be forgiven after 10 years, hopefully. But for any other loans at Penny, we want to make sure you calculate your minimum payment and make sure you're paying a tiny bit more. This goes for personal loans. This goes for medical debt. This goes for car loans and mortgages. Pay a little bit more than the minimum payment. If you look how you adjust your payment, helps you pay them off faster. So this is all about goals. If your goal is, I don't have enough money to pay my payment, this is where I want you to use Savi for your student loans and figure out how can you pay the least amount possible. If you're a high earner, you can pay your payment. Those income repayment plans might not be the best for you, like Lindsay said, but I want you to think through right sizing your minimum payment, because our goal is for you to pay them off in a period that makes you feel good. If $200, if 30 years versus 14 years doesn't make you feel anything, then pay the 500. But if you're like, oh my God, I don't want to wait 30 years to pay off my loans, like I'm going to be thinking about this every night when I go to bed, we want to figure out a personal finance plan for you where you come up with that $200 extra, you're paying that $700 a month, and these are gone in 14 years. I'm going to pause there. Any questions from folks on the different payoff plans, which are right for you, how to go about thinking about your payment and applying to the programs?
Nothing yet.
Okay. The last two topics, and then we're going to open it up for more questions. Consolidation. We hear this a lot. Should I consolidate my loans? Alex on my team is sitting here. You had your sister texted you and said,
we're trying to figure out. This is real
life, real time question.
So we're trying to figure out, when we're applying for the SAVE plan, if she should consolidate some of her loans. I feel like I've read that consolidating loans is not the best because you have a higher interest rate when you consolidate. I don't know, Lindsay, what do you think in terms of consolidating to get access to the SAVE plan?
Yeah. So just to be clear, there's a difference between consolidating and refinancing. So I'll start with consolidation being a free federal process. So it doesn't check your credit or anything like that, whereby you are basically consolidating multiple federal loans into one, what's called a direct consolidation loan. And there are a couple of reasons why you'd want to consolidate. If you had a loan type, like a Parent Plus loan that wasn't eligible for, type of repayment plan, you'd want to consolidate it. or you need to consolidate it in order to make it eligible. All right. So the other thing you can do is if you're in default outside of this Fresh Start program, if you consolidate, that's one way of bringing your loans back into good standing, but you can only do it once. So with consolidation, it basically, combines those loans and your interest rate becomes a weighted average. So that could mean it could be slightly lower. It could mean it could be slightly higher. Okay. So that's consolidation. Refinancing is basically, refinancing what would be a federal loan with a private lender, a commercial lender, thereby turning that federal loan private. A lot of people will refinance to get a lower interest rate, right? However, when you refinance, again, with a commercial or private lender, like a SoFi or a bank, that loan now becoming private makes it ineligible for any of the repayment, forgiveness, or relief programs we talked about here today. So that's something that you want to make sure that you're considering if you are going to refinance, the fact that you are not going to be eligible for any of those programs. And there's no way to turn your loans from private back into federal. Once they're private, they are private for good. So
for Alex's sister's example, then she must have all government loans or one of these loan types where she's required to consolidate to get the SAVE plan, or
so I think she would only be accessible to the SAVE plan with the loans that are not Parent Plus loans, and the Parent Plus loan wouldn't be available on the SAVE plan unless you consolidate. But now that we're talking about potentially the Parent Plus loans coming under the umbrella of the SAVE plan in future, I'm kind of thinking the best scenario for this might be to just wait until that becomes a potential versus consolidating them all right now and changing weighted interest rates.
Exactly. Yeah. We might want to wait to hear sort of, get confirmation that that's actually going to happen before she consolidates. But yeah, some people have a couple of different types of federal student loans. And again, you can consolidate them all together, but it might raise or lower that interest rate because it becomes a weighted average. So you can actually simulate what this would look like on studentaid.gov. There's a consolidation portal, and you can go through and you can see and estimate how much you would pay, sort of before and after that consolidation. So again, for some people, it's necessary based on their loan type for them to consolidate to become eligible, for the SAVE plan or other income-driven repayment plans. But for others, you don't need to, right? Like most borrowers have on average between 6 and 7 different types of federal loans. You don't necessarily need to consolidate them, right? They're all existing. There are some cases when you need to, some when you don't.
Okay.
Are there any other cons to consolidating loans other than the weighted interest rates?
I would say not right now, but there are some things that are going to change starting in 2024. I won't go too much into the weeds, but for example, if you have, let's say, loans for maybe undergrad and loans from grad school that were dispersed at very different times, and you consolidate them together right now before the end of the year, they will basically take on the credit count of the oldest loan. Meaning if you're pursuing those 10 years in forgiveness, let's say you already had 5 years on your old loan, your undergrad, maybe only a couple of years on your grad because they were dispersed, more recently. They're now going to all have those 5 years. So you're going to benefit more. That's not going to be the case after 2024. You might not benefit as much. So I would honestly say consolidation is a really tricky thing that's going to vary from borrower to borrower. And it's really in your best bet to sort of look at your own situation and evaluate that, on your own or through that studentaid.gov tool. And this is something that Savi can help you with as well. Because again, if it's a scenario where your loan type is not going to qualify you, you need to consolidate. But otherwise, like I said, you could be raising that interest rate potentially if you do.
Got it. This is why I love working at Penny, because I'm working with real loan problems, and I think it's a company that is really, really focused on
figuring it out. Let's figure it out.
It's tough.
It's also complicated sometimes.
Thanks.
Okay, I have a question roll through.
Oh, yes, question.
May I interrupt on this topic of how Savi can help me? So this person's understanding she should recalculate her existing save to see what it would potentially be now. But she also has a private loan, which is $500 a month, and she's concerned about having to pay that on top of federal. What should she do first, and how could Savi help her here?
Yeah, I'm in the same position because I have federal loans and I also have private loans. And obviously we had private loans haven't benefited from the payment pause. So we've had to continue making those. Here's what I did personally, because I was in the same boat. I was like, I cannot afford all these payments. I called my private lenders since there's no sort of federal system, basically, which all the private lenders abide by. Your options are going to vary from lender to lender. So I called my private lender to see what potential repayment options there were. If there was, sometimes you can go on to sort of a forbearance, but like if you have a lower income, they might help you to adjust your payment amount. So I would say reaching out to your private lender to see what options they offer for you if you're struggling to make that monthly payment, because $500 is a lot on top, and then in addition to your federal loans. And then I would look into your options for your federal loans on an income driven repayment plan to see how low you might be able to pay, each month. And keep in mind that if you aren't able to afford those federal, you've got that on ramp to repayment, right? So, if you need to, use that can help you. But I would say this, even enrolling in the save plan, let's say you can't afford the monthly payment, even on that save plan, just by enrolling in it, the interest part, right? You won't, any of the interest that goes unpaid if you can't make those payments is not going to accumulate. So you could enroll, not make the payment on save, right? If you can't, but at least your interest won't accumulate, right? So something to consider there if you're struggling. And Savi can help you think through all of this. You can have sort of a one-on-one conversation with our support team, because I know that both looking at federal and private can be tough, and we can sort of walk you through it. So you can set that up through your account.
I would agree with all of that. You have to pay those private loans first.
Yeah.
Right. Because there's less flexibility and less options there. Do call them, ask if there's any options. I don't know. Well, we're going to talk about refinancing in a second. That used to be a good option to potentially lower your payment, but interest rates are so high right now, it's not really an option. So pay your private, enroll and save. Maybe don't pay your federal loans for a year. Just focus on the private. And then just a little plug for Penny. Let's figure out how to make you some extra money so you can pay those loans. So because interest rates are so high, yes, that's not good for loans, but that's really good for high yield savings accounts. So maybe we can boost your savings account and have you earn a little bit of money on that. And you can use that extra money to pay for your federal loan, something like that. Very, very good question. Okay, refinancing. We mentioned this before, but refinancing is effectively resetting the interest rate on your loan. You might have taken out a loan 10 years ago at 5% on your student loans, 5% interest rate. There used to be, because interest rates were so low during COVID, there used to be a really attractive refinance market where you can go apply, this is in the private world, to refinance your loans so that your interest rate drops from 5% to maybe 3%. That saves you money. So if you kept the same payment, you would chip away at your loans quicker. These are interest rates today. Interest rates have soared in the past year. Interest rates rose 7 times last year, post-COVID. So if you took out a mortgage, it'd be around 8%, 7 to 8%. If you took out a car loan, it'd be like 6 to 8%. To refinance student loans right now, it's around 6.5%. So to answer this question on if this is an option for you, you have to look at what your loan rate is today. If you took out a loan at 10%, refinancing it might be okay. You might be able to reduce your interest rate to 6.5%. It depends on what servicer you go with and whatnot. If you're just taking out loans for the first time, you started school or you started grad school, or you're thinking of going back to school, or you have a child who's starting school, the rate is going to be around 5.5%. Just so you have that benchmarked in your brain. The high yield savings rate is 4.5. So when I think about, all the trade-offs you need to make and all the decisions you need to make and how we all figure out how are we paying all of our loans for ourselves and our kids, what I want you to be thinking about is do all of the work up front on your loans to reduce the payment, but then I want you to focus on any savings you have. Make sure it's in a high yield savings account, because you could be earning 4.5% and then you might be paying 6.5%. That closes the gap a little bit on how much money is going out of the bank every month to service these loans. I'm going to pause there. Lindsay, anything you would add to refinancing?
No, again, just, when it comes to student loans, being aware, of the fact that it would turn them private. But if you already have private loans, definitely looking at refinancing, right? You have nothing to lose there. They're already private. They can never become federal. And for many of us, we have super high interest rates on those private loans. So looking to lower that is really going to get you the best bang for your buck. But yeah, no, I think this was great.
That was all the content. Wow, that took 59 minutes. Talk about complicated. Any other looming questions that people have that they're dying to ask? Drop them in the chat, or you can email us. We have a few other slides to go through, but Mandy, any other questions that came through?
Yep, we got one.
Okay.
Had to consolidate when the Biden student loan forgiveness was on the table and my interest rate went up. What should I do?
Gotcha.
So this person consolidated.
Wait, repeat so they consolidated their loans.
Mm-hmm. Their interest rate went up.
Yep.
What should they do now?
What is the interest rate?
TBD.
Okay,
I'm not naming names, but hello, person who answered this question. For your privacy, you're welcome to shout it from the rooftops. Or you can direct
I'll let Lindsay answer this because she knows how to navigate this jungle better than me. But
can you guys hear me?
Yes.
Yeah.
Yeah. So I had to consolidate. So when the Biden administration, when they issued that loan forgiveness, I was one of the ones that were approved. But in order for to do that, I had to consolidate, which I did, and it went up to like 5%. I think I was at 4 or 3% before. So I did that thinking, it was going to be approved, and it did. But then now that it's no longer there on the table, I'm still under that current plan. I just wondered if you guys had any feedback or options I should do.
Yeah, I mean, I would say, looking at your options on like if you wanted to try to lower those, there's no way to do it through the federal system. So if you're, obviously as you're thinking about returning to repayment, looking at an income driven repayment plan, looking at that save plan, right? That's going to help limit any additional interest from, accruing on those loans. Because I think, if you were to look at refinancing them into a private loan, you'd be looking at either a comparable and potentially even higher interest rate. So yeah, Crissi, I defer to you too.
Yeah.
I think that might be something to consider.
Yeah. And Felix, you're in the save plan or the repay plan?
I'm currently in an income repayment plan, income driven.
Income driven. So Lindsay, will his plan automatically convert to save, or does he need to apply again potentially to get a reduced payment, or
so if he's
eligible for that interest to not accrue?
Yeah, if you are in the repay plan, you will automatically be put into the save plan. So you do not need to reapply or do anything. Unless it would be in your interest to not to use the word interest, but it would be in your benefit to submit a new application only if your income had decreased since the last time you had done it, right? Because that's going to get you they're going to reevaluate, and that's going to get you a lower monthly payment.
Yeah.
Okay, so no, my income has increased, so I should not resubmit a plan then.
No, not yet. Not until your recertification. Not until your recertification deadline, which your servicer should let you know what that is. Everyone's got sort of pushed out indefinitely. It's going to be sometime next year.
All right, thank you.
No
Really
problem.
great question.
Okay.
Any other questions?
Yes. And we'll be here until next year in a beautiful way. You guys are just so helpful. Can you make additional payments on federal loans when you're not required to make a payment so that it goes directly to the principal? Wondering if lowering the principal will help lower monthly payments in the future.
Yeah, absolutely you can. And if you lower the principal, that's a great tactic. If you lower the principal, if you're on a standard plan, that's going to lower your monthly payment. If you're on an income-driven repayment plan, it won't affect your required monthly payment, right? But you can still make those additional payments. But that, I think, is probably one of the most powerful ways to actually get your balance down, you know, and start making significant dents in it.
Yep.
So you can make as many ad hoc additional payments each month towards your student loan balance. As long as the interest is covered, then it will go towards the principal.
Right. Great question.
No questions yet. If you want to have a closeout, Crissi, we can end the
Yep.
recording and take it from there.
Okay, so the last thing is for all of you that attended and signed up for this, you get Penny for free for a month, so you can use all of our tools. The ones I showed on this call are free anyway, but there's also some more repayment and debt tools within Penny, and then focus on high yield savings account and all those tools. So if you use Master 10, you get Penny for free. And then we are partnered with Savi. They the service that Lindsay was going through, where it shows you all of the different options, that's free. But then if you want Savi to submit the application for you and get it all done, so you need to think about it, that's $60 a year. And that's a discounted rate for being a part of Penny. So we'll send around all these links, but our goal is to get you access to all of the resources you need in the most accessible way possible. So Master 10, and then if you scan this QR code, that's Savi's site. You could, of course, reach out to anyone on the Penny team, anyone on the Savi team. We want to help you. We want you to navigate this and help you figure this out. So reach out to us anytime. We will send a recording of this. It'll be available for a month, so you can rewatch it, send it to friends. Thank you, Lindsay, so much for joining us. I learned so much. I've been in this world forever. I know everyone else did too. For our members who joined, great questions. This was so helpful, and just pay it forward. Anyone in your life who has student loans, talk about this. Share with them there are options. You don't have to die with your debt. We don't want that to happen for everyone. So thank you again for joining, and good luck with your loans.
Thanks, Crissi.